This has the banks terrified. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have new data that shows the subprime crisis is here and is on the cusp of getting much worse. And this time, the banks will be powerless to stop it, as I'm going to show you what the triggering mechanism will be, because when that happens, it's game over for the banks. And plus, we've got some new information that shows that consumers are going to be getting even further behind on their payments, putting even more stress on the banks as the subprime crisis goes full blown. And we've got a sponsor for today's show. I'm going to give you 7 reasons why you may want to add this stock to your portfolio, including a chart setup that says this stock is likely to go straight up. Stay tuned to the end of the show for more information on our sponsor. Now let's head over to the Wall Street Journal, where we picked today's story up with a headline: More auto payments are late, exposing cracks in consumer credit. Some 9.3% of auto loans extended to people with low credit scores were 30 or more days behind on their payment at the end of last year, the highest share since 2010, according to a recent analysis by Moody's. Now, this is important because, when we talk about subprime and we talk about financial crises, we can go back and we now see how obvious the housing market was going into the great financial crisis. Today, is there a bubble in housing? Well, likely there is, but not to the extent that we saw back then. The bubble, what I've maintained and is going to first start in the automobile market and then turn into the credit card market and eventually the housing market. And you're seeing it right now because there are more auto loans, subprime auto loans, than there were subprime home loans in terms of a dollar amount. And you can imagine that you think about the housing market, there's a floor on prices. There's a point where people will buy. But when you think about cars, they depreciate every year. They break down, and the banks don't have any experience with selling these cars, and they're going to get stuck with a load of them, and you're going to see just how bad it's going to be. The past few years have been unusually good for consumers who stowed away extra money during the pandemic due to all the government fiscal stimulus, but now sky-high inflation is eating away at those gains. We're going to put that to the test here momentarily. Car prices in particular jumped because of shortage of vehicles, and many borrowers took out large loans to buy them, leaving little breathing room to keep up with payments if they hit a rough patch. And you think about this from the consumer's perspective, they were being given a ton of money for the government. In many cases, people were making more money when the economy was shut down than they were employed. And what did the government tell them? Hey, when we are done with this pandemic, the economy is going to boom. We heard that from the media and policymakers and everybody saying the economy is going to boom. So people went out and bought cars. And now what we're finding out, the economy is slowing and they can't make the payments. Now, the question we should be looking at here, does inflation follow into the story of delinquencies? And the case is, yes, it should. What we should see is inflation rise first. Consumers try to keep up with it. And then when they can't, we should see with a lag delinquencies kick in. And this chart says that's absolutely true. Here we have the consumer price index in blue against the delinquency rate on all loans. And what we can note here, going back to the 80s, we see inflation rising. We see delinquencies. Now, they seem elevated compared to today's standards, but they were stable. And the next thing you know, they went higher. We can see again going into 2000, consumer prices rise. With a lag, delinquencies kick higher. How about here in 2005? We're seeing inflation rise, but notably the economy was rather strong there. And then you get this big drop of inflation, which kind of is a pressure relief valve off delinquencies, though they're just starting to increase. But look what happens. Consumer prices rise, delinquencies follow suit, and now we see, of course, consumer prices off the chart historically compared to at least where we've been for decades. And if you've wondered why the Fed is so worried about getting inflation down, it's because they know consumers can't make their payments. And if they can't get inflation down fast enough, it's going to lead to delinquencies, defaults, and then it's all going to come pointing back to the Fed and the banking system. Stress in the auto loan market is concentrated among borrowers with credit scores below 660 and especially high among people with bottom of the barrel credit. But the stress could spread, I'll just say will spread, if the U.S. goes into recession, and if job losses increase, many more consumers will find themselves unable to keep up with the record amount of debt they took out in recent years. As we talked about on a recent show, the debt now is at all-time highs. Something has to break. The banks say they've got this, but I don't think they do at all. And here we can see the share of outstanding subprime auto debt that is more than 30 days delinquent. Notably, you see it rising going into the great financial crisis. Then after that, it settles down, and it was steadily increasing as we headed into the pandemic. Notably, we were likely headed into a recession. All those government transfers solved the problem, and just now look how fast that this is accelerating to the upside, telling us we've got big problems coming for the banks. And when we start talking about this employment situation, so then, if we look at the big picture here, what we should see is consumer prices rise, and then delinquencies start to kick in a little bit. And then when the unemployment rate starts to rise, or we see initial claims start to rise, what's happening is people that are spending money can't keep their lifestyle up because of inflation. They cut their consumption back, the economy slows, then layoffs happen, and the next thing you know, delinquencies go off the charts. And here we can see that just happening here, the 4-week moving average initial claims rising. We know that's following inflation higher, delinquency rates, and then they go skyrocketing higher. Again, delinquency rates are rising, the unemployment initial claims go shooting higher. So now what we're waiting for here is to see, this is the triggering point. When you start to see initial claims for unemployment head higher, watch out. There's no stopping this, and it's going to be completely game over for the banks. And borrowers took out big loans at the height of the boom, far more than their vehicles are worth. Those buyers are sticking lenders with bigger losses when they fall behind, because one thing we can note is people rolled their negative equity from their other vehicles into their new vehicles. Banks were more than happy to lend against it. So now we have a case where when people default and these cars go back to the banks, they're going to take even bigger losses than they should due to poor lending standards. And Ally Financial, which operates a large auto lending business, said in January the loans extended between mid-2021 and 2022 are experiencing bigger early losses than other loans. In the fourth quarter, the percentage of its car loans that were more than 60 days past due rose above pre-pandemic levels for the first time, indicating what we're suggesting here is as subprime borrowers hit delinquency, it eventually follows through other class of borrowers and gets to prime borrowers. They're the last, and here we can see subprime delinquency rates among credit score. We see the worst rising and then the rest falling behind, which is telling me that in the months to come, we're going to be doing a report about how prime borrowers are hitting delinquency, and that's not a good sign. Again, where subprime goes, everybody follows, and we start to now look at some other data which suggests that consumers will have no choice but to fall further behind on their payments. As persistent inflation is keeping grocery prices high for consumers, they were up a whopping 11.3% from a year ago in January, as a high cost of groceries hits fixed and low-income families. Again, think of these as your subprime borrowers, particularly hard. And for those receiving Social Security, the 8.7% COLA that took effect in January this year, it still leaves them behind, and they don't have enough for groceries. And we add to this, the survey found shoppers are spending an average of $151 a week on food, which is below the pandemic peak of $161. And of course, the stores are doing what they can to help consumers, but what you're seeing here is the case where consumers are falling behind due to high prices. They're starting to cut their spending. This is going to cause employers to also cut the number of workers they need, cut their new order demand, and you're going to eventually see this unemployment start to tick higher. We're going to see initial claims start to tick higher, and watch in the months to come. When they do, these delinquency rates are going to skyrocket. They're going to lead to defaults, and this time it's going to impact the banks in a much bigger way, because as I mentioned before, there's a much larger dollar amount in used car loans than there were in subprime home loans. When that hits the banks, they're going to get devastated. Now let's take a look at our sponsor for today's show. I want to introduce you to Actinium Pharmaceuticals. I'm going to put a link to their website and their stock symbol and the research report we're going through in the description and in a pinned comment. And they are working on targeted radiotherapies for patients with unmet needs, as Actinium is developing a pipeline of antibody radiation conjugates for targeted conditioning and combination therapies. Let's take a little bit deeper look here at actinium, because I want to get into the charts and show you this is an incredible setup, and then we'll get to those other reasons why you may want to add them to your portfolio. Here we can see Actinium Pharmaceutical, symbol ATNM. Again, add that to your watch list. They're a clinical stage biopharmaceutical company applying its proprietary platform technology and clinical experience to develop novel targeted radiotherapies for patients with unmet needs. And these targeted radiotherapies also enable the broader application of radiation than external beam radiation, as they can be used in the treatment of both solid tumors, blood cancers, which generally cannot be treated with external radiation given their diffuse nature. So you think about why you should look at Actinium Pharmaceuticals, put their symbol ATNM in your watch list, do your research. Again, check the links below for that. Is because we have this massive wave of baby boomers hitting retirement. They're going to have health issues. They're going to be looking for the latest technology. And of course, we can note that Actinium has that technology, and there's going to be a huge demand for it. Now let's take a look at the 7 reasons why you may want to add this stock to your portfolio. Plus, we'll get into the charts here momentarily. According to tipranks.com, H.C. Wainwright analyst Joseph Pantginis reiterated coverage on Actinium Pharmaceuticals with a target of $53. And according to barchart.com, shares of Actinium Pharmaceuticals, symbol ATNM, bounced off to a 52-week low of $4.41 on March 15th of last year, indicating a potential upside if it hits that analyst target of $53 of 1,100%. And we should note that a move that high is not certain, but the potential upside should be noted here. And now let's take a look at the chart setup, because I want you to see why they're making that call for $53. And if this thing squeezes higher, as I think it should, and it could, well, it's going to go even higher than that. Let's take a look. Here we can see going back 5 years, I've overlaid this purple line with where the volume profile is. The most shares have been traded at this line here, and you can note massive accumulation going back for years as people are looking to buy under this $8.17 mark. They're accumulating a massive number of shares here, and we can note that what happens is when it broke through there, as we can assume happens in these chart setups, price tends to rocket higher and then go higher a second time. We've seen it break through as sellers, of course, on the other side of the trade, were looking to unload their shares, but these big players continue to accumulate. Now it's broken through, and what you may see as a double top here, hang tight. It's not at all. This is another second wave of accumulation going on, because I want you to note that, see this little volume popping out here? Well, that's going right into here, and check this out on our next chart. That stock broke through to the upside. Sellers came in, as we'll look at here in a moment. But what we can note is there was even more accumulation now here at the $10.70 level, as buyers want more of the stock, as they're expecting it to go straight up. And here you can see the sellers were indeed where we would expect them, right at the top of that first move. But notably, the volume profile right here again, where this purple line is, accumulation came in, price broke through it a second time. Sellers are still here, but not as strong, when what that's suggesting is this stock is poised to go a whole lot higher. And now you've got the 10-day window. You can see accumulation coming in here, looking to take Actinium Pharmaceutical, symbol ATNM, straight up. And when you look at a long-range chart, you think this $50 price level is right here, and that only takes you back maybe 6 or 7 years. You can see there's been a major amount of accumulation here, and somebody's looking to take this stock a whole lot higher, and that is the story for Actinium Pharmaceuticals from their chart perspective. ATNM, again, put that on your watch list. We'll have all the research report in the link and description below for you, and as a pinned tweet. Let's look at this. They have potential for growth because historically small cap stocks have outperformed large caps. And of course, we know Actinium Pharmaceuticals is indeed a small cap stock. As of February 10th this year, they had over a $309 million market cap. They're a potential acquisition candidate as large companies look to gain intellectual technology and property by buying smaller businesses. That would mean if they did buy Actinium Pharmaceuticals, they'd pay a premium, sending the stock even higher. They have a lot of intellectual property as the company's clinical pipeline was developed from its antibody warhead enabling technology that now has over 195 issued patents and pending patents and trade secrets. The company is advancing its pipeline of clinical stage development programs that they believe can improve patient access to potentially curative treatments and improve patient outcomes. And based on its knowledge, they're the leading company in this space. And from the FDA's position, they're intending to submit a biologics license application here in the near-term future for its Lomad B to address patients, again, age 55 plus, which I said is a big deal as all of these boomers hit retirement. They're going to be looking for the latest technology to extend their lives. And we know that Actinium Pharmaceuticals, symbol ATNM, has that technology. We can see a massive amount of accumulation in their stock chart, looking to take this higher. But again, don't take my word on this. Do your own research. Check the company out. Look at the research reports. Look at the stock charts and make your own decisions. And then with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.